Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm joined today by AXA Bond Fund Manager Nicolas Trindade. Hello, Nicolas.
Good morning.
So a bit of a lengthy title, your fund, AXA Sterling Credit Short Duration Bond Fund. I thought we could pick it apart piece by piece, starting with sterling. A lot of equity investors at the moment who invest in sterling are seeing an implication from our currency being significantly devalued. Is that the same for bond investors?
Well, the thing is that in our sterling credit short duration bond fund, we fully hedge currency risk. So we do invest in non-sterling denominated bonds, but we hedge the currency risk, which means that we don't have any currency risk within the portfolio. But now obviously a lower pound can have an impact, it particularly can have an impact on inflation. And what we expect is we expect to see higher inflation on the back of a lower pound. And obviously if you have a higher inflation, that could lead to higher yields. And that's why having a short duration emphasis within the portfolio is quite attractive, because that gives us the ability to benefit from higher yields because of higher inflation. And
short duration bonds are those with shorter terms. I mean, people think about this in terms of mortgage. You fix your mortgage for 5-10 years, and that's good when you're a borrower because you want rates to remain low for as long as possible. But potentially with bonds, yields moving around so much at the moment, short duration is a real positive.
Yes, no, definitely, because we define short duration as bond with less than 5 years maturity. And when you invest in a short duration bond fund, you lower your duration risk, you lower your credit risk, and you lower your liquidity risk. And we think that in this environment where we have a big disconnect between fundamentals and valuations, and where there's a lot of risks going into the end of the year, the US election, the Italian constitutional referendum, the Fed rate decision, and obviously more noise around Brexit, there's a strong case to actually de-risk your fixed income allocation and move to a shorter duration bond fund that will help you lower all those risks.
Of course, at the very beginning of this year, no one thought Brexit was going to happen. So if you'd said at the beginning of this year where you expected Bank of England to move bond yields, you would have thought they would be putting the interest rate up. But they haven't, they've cut it. And they've also introduced fresh rounds of quantitative easing with perhaps more stimulus to come. How does that affect the way that you run a bond fund?
Well, to be honest, the announcement of corporate quantitative easing actually come to a surprise to us, and I think came to a surprise to the market. We're not expecting the Bank of England to announce a 10 billion program to purchase corporate bonds, and that had a tremendous impact on the market. And what it's done is basically further distort prices in the fixed income market and further increase the divergence that we have between fundamentals on one side and valuations on the other side. And the market has performed really well this year despite Brexit, and that's why we are quite cautious and we haven't been keen on chasing the rally, because we're just really worried about the valuation at this point in time. And in the portfolio that I manage, for example, we've been more erring on the cautious side, and we've been actually increasing the cash balance and investing most of the money in defensive sectors, because we think there's going to be a repricing at some point, and we want to make sure that we are in a position that we can benefit from it.
And you said there's going to be a correction in the market, a repricing in the market. Yes. Obviously, bond yields have been very low for a long time. That means prices, of course, are rising, which is great in total return point of view. Where do you foresee a return to normality? Is it next year? Is it the year after? Or is it much further out than that?
I think it's going to take a couple of years before we can get back to normality. But in the meantime, what you may see is a lot of volatility. And October is a very good example. If you look at the yield on the 10-year gilt, it went up by 40 basis points. It's a big move. Now the yield on the 10-year gilt is back above 1%. At the lowest in mid-August, it was at 50 basis points. So we've seen a big move. That means big negative total returns for the average corporate bond fund, because the average corporate bond fund will have a duration of about 9 years, so a very high sensitivity to rising yields. And it can be a really big issue for some investors. And that's why in this environment where we expect volatility to stay quite high, I think there's quite a strong case basically to look at de-risking your fixed income allocation, because a lot of investors would have done really well year to date. I mean, double-digit returns year to date. And I think it's very dangerous to be too greedy and try to look for the next percentage point of returns when you've done already so well and where there's so much risks ahead.
Nicolas, thank you very much.
Thank you.
This is Emma Wall from Morningstar. Thank you for watching.